Hello friends. Last week in my video, I told you that geopolitics had the potential to bring the markets down and a correction could set in. I gave you 7 red flags in my video and sure enough, the markets did not disappoint those expectations. What lies in the week ahead? The rally that you saw on Friday, is this a bottom being put in place, or is this a pullback rally that is just triggered by the RBI's interest rate announcement? In this video, we are going to take a look at exactly that. There are 2 extra charts that I have put in the segment of the Outlook on the Nifty and the Bank Nifty, which will examine whether this is a pullback rally or a firm bottom being put in place. So let's dive right into the market, and what you're seeing on your screen is the market roundup window, which tells you that it was a banking space that led the decline, expectedly so, because the week was dominated by interest rate decisions. The US dollar index eased a little bit, to be precise, by 85 basis points, and that kind of cushioned the declines in our markets. Since the dollar is the invoicing currency for commodity trades, bullion as well as energy went up a bit. 10-year benchmark bond yields fell, and I do expect bond yields to be a little volatile as compared to recent past. Finally, they'll stabilize and possibly even rise a tad. On my Telegram channel, I put up a special update immediately after the RBI governor put out his address. Do check that post out whenever you get the spare moment. NSE market capitalization fell a little under 1.75%. MWPL fell, which is routine because do remember Thursday was expiry, a monthly one at that, and the US indices provided headwinds to the Indian markets by falling approximately 3%. On your screen right now is the daily chart of the Dow Jones Industrial Average. The death cross, where the 50-day moving average is below the 200-day moving average, remains in place. As a matter of fact, is gaining momentum. 29,500, that's a level I've been talking about since the last couple of weeks, was violated, and that too with a comfortable margin on a sustained closing basis. On the upside, this level, give or take 100-150 points for emotional turbulence, will be a resistance area. Do note how this index has fallen on 4 out of 5 trading sessions. That underscores the nervousness in the index. The Nasdaq 100 index, which has a direct bearing on Indian IT stocks, has also fallen below its previous swing low of 11,037. The closing is below that, and that's just Friday, of course. For a confirmation, we need a couple of days of closing below this level. And do remember that the death cross that I talked about in the Dow Jones is existing in the Nasdaq 100 itself. So the outlook on Indian tech stocks remains that of under pressure. S&P 500, the most broadest based index out of the 3 US indices that we talk about, also violated its previous swing low at 3,636 and closed below it with a big margin. Death cross here remains in place. So we've been taking the lead in providing you a 360-degree worldview of the markets and telling you to look at all the statistical evidence present. And here you are, the US is likely to provide headwinds, which means resistance to the Indian market. So that is one red flag. Coming to our own markets, the MWPL, the market-wide position limits, which have cracked to 21.65, which is expected because Thursday was expiry. Not everybody rolls over their positions to the next trading derivative series. And what is noteworthy is what I have been telling you in my videos as well as my live mint column, India's first media column to provide statistical inputs to its viewers. I've been telling you that traders will experience the LIFO phenomena, last in, first out. So the most recent trades that were initiated and when they become loss-making, when they turn loss-making, will be dumped first. That's precisely what happened. After hitting a period high at 33.59, the MWPL has fallen to its lowest after the July expiry. In the July expiry, it went to 21.48. In August expiry, it rose to 22.09. So risk appetite has contracted apparently because LIFO, last in, first out, the most recent trades which have turned southwards, downwards, loss making, have been dumped. Now for the stock index futures turnover. Remember, these are cumulative figures for 3 derivative series expiries. What we are seeing is the index futures turnover has hit a 20-week high. This is not exactly good news, not good for both bulls. Why? Because 1 and 2 marshmallow traders have participated in the selling, which means they are okay with a decline and they are possibly cool-headedly going to press sales. Stock futures turnover has come down, which is actually a negative. You might think that a fall with lower turnover is a good idea, but I have recorded a video precisely on this topic. Are falling volumes good in a falling market during phases of declines? The hyperlink to that video is in the description and in the pinned comment below. Do check that video out. So it seems the retail trader has been frozen like a deer in the headlights of a car on a highway, and turnover in the stock futures space has fallen in spite of the fact that this was an expiry and turnover should have risen purely because people are squaring up September and initiating fresh trades in October. So that should result in double turnover, but it hasn't. This is another red flag. Now, coming to the advanced decline ratio, which jumped to 2.53. This is purely because of Friday's optimism and a big jump after the RBI governor announced the interest rate hike. Can this advanced decline ratio of 2.53 be sustained? I have my doubts, because whenever the advanced decline ratio has jumped significantly and suddenly, it's basically cooled off in the immediate future and there has been a little bit of profit taking. So let's be careful out there. Let's watch the advanced decline ratio, because after the price, this is the most leading or advanced indicator to tell us which way the winds are blowing. Ideally speaking, this ratio must remain above 1 and the indices must continue to rise. That's when I think the rally would be sustainable. Now coming to the basis of the Nifty and the Bank Nifty prompt month futures. Basis is nothing but the discount or premium enjoyed by the future compared to cash. What we are seeing is the Bank Nifty basis jump up significantly. Two reasons are responsible for this. Invariably, after the expiry is done and a new settlement kicks in, the premium jumps sharply because traders have 4 more weeks to play around with and they are willing to pay a premium to buy time. And secondly, short covering. If traders have been caught on the wrong foot in their shorts, they tend to square up their shorts, which is the second reason why basis goes up. Now, the Bank Nifty, which had significant buildup of shorts ahead of the RBI Monetary Policy Committee announcement of interest rate hikes, have seen shorts being extinguished, and that's why the basis has jumped to 175. In relative comparison, the Nifty basis has hardly moved in spite of the fact that a new derivative series has kicked in. That tells me that there was a divergence between the Nifty and the Bank Nifty's outlook, which is not exactly a great sign. I would watch out for basis inversion. Inversion meaning discount of future over cash. If that happens, there could be further selling pressure. But right now, so far, so good. For 2 months, basis hasn't inverted, and that is a good thing for the impetus. And this is a sign of concern as far as I'm concerned. For 1.5 years now, you've trusted the impetus chart. And I brought it to your notice last week as well, both in my video and in my live mint column, that the bank nifty impetus may have cooled last week. But the nifty impetus has been rising for over a month and the index has been under pressure. The fact that both the indices have fallen, and had it not been for the spectacular rise on Friday, we would have ended the week very, very sharply down. In spite of the fact that Friday was a face-saving session, markets have logged declines and impetus on the bank nifty is at its highest in 5 months. The duration of the chart is 20 weeks. The impetus of the nifty itself has jumped sharply and has risen for 5 weeks in a row. That tells me that the selling was pretty forceful. That is another minor red flag. All these flags, apart from the US indices, can be reversed if the price is reversed. But the fact is that they are stacking up on each other and we should be taking note of them. Now for the LWTD, which tells me that the blue line, the Nifty percentage gain loss, has jumped above zero, but the LWTD line has sunk below zero a little more as compared to last week. That tells me that at higher levels, because the Nifty percentage gain loss line is up, let's assume that the market goes up. At those higher levels, follow-up buying will be a little measured, will be mild, will be weak, will be tepid. Bulls don't seem to be very, very enthusiastic as of now. Ideally speaking, I would want the Nifty percentage gain loss line along with the LWTD line to rise together. Till that does not happen, I would not want to carry over my long positions from day 1 to day 2. I would initiate long positions if justified by charts and other ancillary evidence, but I would ideally book profits on the same day. So there you go. The LWTD is another sign of concern. Let's now go to the footprint of the 4 market participant types, starting with the FIIs. They've basically increased their index net short positions and cut their individual stock futures shorts and have turned net buyers in individual stock futures. Very small extent, but there they are. Where DIIs are concerned, they've increased their net short positions in both the index futures as well as stock futures, and that tells you that these guys are buying in cash and selling in futures. That is what they do. They seem to have a hedged outlook towards the market. Where prop traders are concerned, these guys are the sharpest market participant types. These are brokers' own trades. They know who's buying, who's selling, so they are second best to insiders. They've reduced their net long positions in individual stock futures and gone net short in index futures. That is a sign of concern. Let's now see what the retail guys have done. These guys have been doing all the heavy lifting after the COVID-based lockdowns. They've cut down their individual stock futures, net long positions. Do remember, part of it could be explained by expiry. And they've increased their net long positions in index futures substantially, which is why you saw that participation levels, the turnover in index futures is hit a 5-month high. Let's now come to the 4 index heavyweights, because we like to take a well-rounded approach to see whether the market is merely going through a correction upwards or is a bottom been put in place. This is the crux of this video. Is this a correction, upward correction, or is the market hit a bottom? So let's take the heaviest weighted big boy of them all, Reliance Industry. It's been violating support after support. So 2006-18 gone, 2542 gone, 2402 gone, 2,365 gone. Now, on the upside, all these violated supports will become resistances. So now the primary thing that Reliance needs to do after a spectacular bullish candle on Friday is to stay above 2,402 and try and approach the 2,542 levels. Remember, with a weightage of 11.51%, this stock really matters a lot to the Nifty. Let's see coming week what it does. HDFC Bank with a weightage of 8.36% in the Nifty and 26.21% in the Bank Nifty is a very critical stock, because not only does it impact the Nifty's outlook but also the Bank Nifty's outlook. See how it's violated the 1,410 levels and closed below its 25-day exponential moving average, which is a proxy for a month-long holding on cost of a bull. So now the short-term buyers are in trouble, with 1,337 levels being a support area to watch out for. As long as this support is not breached or violated and the price goes above the 25-week exponential moving average, the bulls have a fighting chance to come back. The third heavyweight in my list is Infosys with a weightage of 7.54%. Remember, the Nasdaq 100 is plunging down and therefore the Indian technology stocks are going down with it. However, this counter has rallied on 5 out of 5 days last week. And I have recorded a video about how a falling rupee does not necessarily help technology stocks. The hyperlink is in the description as well as the pinned comment below. Do make it a point to watch that video, please. So what we need to see is whether Infosys is respecting the 1,367 support area marked by a thick blue trend line or falling below it. If it falls below 1,367, you have further declines coming up. Ideally speaking, I would want Infosys to go above the 1,555 level. That's when I would say that bulls are attempting to come back. That's a long shot. The fourth and final index heavyweight, ICICI Bank. I've often told you that this is the strongest chart pattern out of these four counters. Do see how very neat and cleanly the price has bounced from the 836 swing high support, which was made in the early January 2022. This is why you do not delete old trend lines from your chart. Now, the 867 level has become the intraday hurdle for Friday's rally. This is another swing high that was made in 2021. The price is below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. We need to go above that level and close above the 885 or 890 levels, ideally, for the bulls to come back with strength. So, one stock, ICICI Bank, holds promise. The other three, Reliance, HDFC Bank and Infi, are appearing jittery. So, that tells me that the bulls really need to pull up their socks and push the markets higher with strength. Friends, last week, the entire market sentiment was dominated by the interest rate decision. First, it was overseas central bankers, Bank of England, US, India, followed on Friday. So bond markets had to assume a significant amount of importance. Look at the way how bond yields have attempted to basically run up on Friday. All right. That tells me that we have been pushing you towards looking at bonds very seriously. And I'm very glad. Thank you for all your messages and your appreciation via WhatsApp, via direct inbox messages and emails about having invested in the bond markets in the RBI's retail direct GSEC scheme portfolio, where you can trade directly with banks without any brokerage, without cost commissions and other ancillary charges. So your capital is safeguarded, because unlike a bank where only 5 lakh rupees is protected by insurance, sovereign bonds are 100% guaranteed by the central government of India. And I believe the yields are likely to go up. Do remember that banks have immediately announced on Friday, some of these banks have started raising their interest rates charged to borrowers, which means EMIs are going to go up. It's a matter of time before deposit rates also go up marginally. Do keep laddering, and as I've been telling you on my social media accounts, in a very disciplined manner, keep deploying money in sovereign debt. That's what I am going to be doing as well. I'll keep on updating you about sovereign and any important updates on this matter on Telegram and my social media accounts. So do take the effort of connecting with me. My contact coordinates come at the fag end of this video. Friends, I now come to the US dollar index, extremely critical for emerging markets, including India, because we are net importers and the dollar's level determines our imported inflation, because fuels, especially if the dollar is strong, landed cost of fuels tend to go up. What you are seeing on the daily chart on your screen is that the US dollar index, which fell by 85 basis points, has lost ground on 3 out of 5 trading sessions last week. Watch the 25-day exponential moving average, which is a month-long holding on cost of an average bull. The price currently is above that level, but it must not violate the same, which is currently between 110.5 to 111. It'll move up a little bit. So let's arbitrarily say watch the 111 mark. The weekly chart on your screen tells you that there's an inverted hammer seen in the week gone by. That tells you that bulls were clearly on the back foot where the US dollar index is concerned. Do note how far the price has run up above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So mean reversion is likely, which means the price will either go sideways and the moving average comes up, or maybe the price will fall towards the moving average before rallying again. So mean reversion itself tells you that there is a possibility of profit taking being seen on this index, which would be a good thing for emerging markets. Friends, last week I advocated a range between 115.10 on the upside and 110.95 on the downside, which held perfectly well in spite of all that volatility that you saw in the week. In the coming week, I expect a range between 114.35 on the upside and 110 round number on the downside. Friends, the dollar index done. I now come to the bank Nifty, which surrendered 2.31% on a week-on-week basis and led the downside. It fell on 4 out of 5 trading sessions, as you can see on the daily chart on your screen, and also fell below the 25-day exponential moving average, which tells you that short-term buyers are now in trouble. The previous swing pivot at 38,759 needs to be overcome on the upside with a great degree of force, and the 25-day exponential moving average and a round number of 39,500 should be overcome before we can say that the bulls have a chance of coming back with any seriousness. Let's take a look at the weekly chart. It shows a bearish hammer, which means the prices went down during the week but closed towards the upper end of the range, even though they closed below the open as well as closed below the previous week's close. Note how the price has jumped from the 25-week exponential moving average, which is a 6-month holding on cost of an average bull. That tells me that this level assumes importance. The 37,950 odd levels, give or take a little bit for emotional turbulence, needs to be watched as a support which the bulls must defend in case of declines. Now, the hammer is primarily because of Friday's move. Do remember, Friday was one day where bears have covered their shorts aggressively, after the RBI announced its interest rate decision. Now for the additional chart of the Bank Nifty that I put up for you, a very simple tool, a Fibonacci retracement. I've taken the recent swing high as a starting point and Thursday's low as the ending point. Do note that the price has not even retraced 38.2% of the entire decline. And the 25-day moving average remains an overhead supply for now. So at this point in time, I will not venture out and say that a hard bottom has been put in place. I do admit that this could be a corrective rally which might become a hard bottom provided I see a 61.8% retracement level being overcome, which is approximately at 40,250 odd levels. So if the price starts to trade consistently above 40,250, I would say yes, the bottom has been made. In the interim, before that happens, would I like to buy? Yes, I would buy for an intraday basis, provided my signals justify that. Hey, I go by the statistical signals. As you all know, I have an in-house statistical model which we put in place. So I would of course buy if it is warranted, but I would square up on the same day. Because leaving overnight positions till the situation is hazy is not exactly a great thing to do. So friends, in the week before last, this index was at number 6 on our in-house volatility list that we maintain, or the highest volatile counters. But it has jumped 4 notches. Ouch, that's trouble. Because the higher the statistical beta or pure intraday volatility, the bigger is a challenge for a retail trader. And a sectoral index, a heavyweight like the Bank Nifty, being at number 2 in a statistical beta list tells you that the prices are jumping all over the place before the retail investor can react adequately. So please be very careful, put your stop losses in place and trade light. Last week, I advocated a range between 41,125 on the upside and 37,950 on the downside, which admittedly was breached because of the huge volatility. It made a low of 37,386. In the coming week, I expect a range between 40,250 on the upside and 37,000 on the downside. Please do trade light. Friends, I now come to the Nifty 50, which lost 1.34% on a week-on-week basis and fell on 4 out of 5 trading sessions last week. The price, as you can see on your daily chart on your screen, has bounced from a previous June swing high of 16,794, which is why I tell you why you should not delete your old trend lines. This is a concept that is also covered by Constance Brown in her book, which is an approved CMT level technical analysis textbook, Technical Analysis for the Trading Professionals, 2nd edition. So what we know now is that the bulls will have to defend the 16,794 level in case of declines and trade above the 25-day exponential moving average and close the gap, which would be filled if we go above the 17,350 odd levels and trade sustainably above that threshold. Prior to that, this is a corrective rally only at best. Take a look at the weekly chart on your screen. We've violated the 25-week exponential moving average on an intra-week basis, but closed above it thanks to the bearish hammer, which was exactly what the Bank Nifty also logged, primarily due to the big rally on Friday. Now, the tops that are connected from October 2021 and thereafter, that downward sloping thick red trend line needs to be overcome. That would happen at 17,600 odd level. Only then will the bulls have significant firepower to be able to dominate the bears. I now come to the extra chart that I have added this week, a Fibonacci retracement. Look at how, just like the Bank Nifty, we have not even retraced 38.2% on the Nifty's decline, which tells me that sure enough, the bulls have bounced back with a great deal of force. But for a hard bottom to be put in place, I would want the 17,650 level to be overcome sustainably on a closing basis with higher volumes and open interest expansion. Then I don't mind taking long positions overnight. Till then, would I buy? Yes, I would buy. I would square up on the same day. That's just it. I would not roll over my long positions. That's my risk management in place. Friends, I now come to the retail risk appetite which they display by way of their exposure in options and futures. I believe in a 360-degree worldview, and statistical crumbs that are left as signals for a smart trader are ample evidence to tell us which way the markets want to go. Look at the light blue line on your screen, which tells you the percentage turnover contributed by the stock option series. The olive green line is the stock futures contribution of the entire turnover. What we can see is that stock segments contribution on this daily chart is lower than last weekend. It's not really surprising because initially itself we saw in the futures space of 3 cumulative series, which is October, November and December, that the turnover was clearly dominated by the index futures. That is something that you're seeing on this chart itself. Now that tells me that retail traders have got caught on the wrong foot in the decline that we saw last week, which is why they are not shuffling their positions. They are not trading too often in the individual stock futures, but are proactive in the index space. Indices in India gyrate between 1.25 to 1.75% intraday basis where movement is concerned, price mobility is concerned. But individual stocks can go up to 3 to 3.5% intraday basis. And if volumes are in the lower beta, lower range products like the indices, clearly risk appetite is down. So that tells me that the retail is on the back foot. I would want this metric in addition to the other red flags I told you. I want them to disappear, the red flags, and price volume and open interest to go up on the long side along with the impetus readings. Friends, charts done. I now come to the most popular segment of this video for statistical model traders. I give you 5 stocks which gain the highest amount of impetus on Friday. So you take small exposure on Monday, but wait for large price moves. And 5 stocks that lost the most amount of impetus on Friday. So you take big exposure, wait for small price moves. Those are for scalpers. Do remember this list is valid only for Monday. In case you want to be updated Tuesday through Friday, please subscribe to my free Telegram channel, and wherein I put up a lot of statistical stuff. We've started putting up content on commodity markets as well since the last few days, and we've received a very warm feedback from you, and thank you for your encouragement. So the 5 counters that are high beta, high impetus gainers, which you will trade in small lots but play for big price moves, is led by Adani Ports, followed by JSW Steels, number 3 Aarti Industries, number 4 SBI, number 5 MCX. The impetus losers, where you'll take big exposure, wait for small price moves, is led by BEL, followed by Infi, third is TCS, number 4 India Mart, and number 5 Walters. Friends, before I draw this video to a close, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And how was your trading week? How was I able to help you during the trading sessions in the coming few days, thanks to my videos and charts that I put in there? I would love to have your feedback on the same in the comment section. And please share my video with smart investors and traders like yourself on social media, your WhatsApp groups, and other platforms, so as to help me reach out to a wider, like minded audience like ourselves. I wish you have a very, very profitable trading week ahead. Thank you for your patience. Till we meet again, this is Vijay Bhambwani signing off for now. Take care. Bye bye.